what other source of fundings, both maybe institutional or non-institutional, is available to finance apartment projects that maybe out there that we want to talk about?
Sure. So it's really, there's some USDA products for rural properties.
Okay.
So if it's in an area where the population is less than 50,000 and it's designated rural, you can do some USDA. I don't do a lot of USDA, but it is available. You have obviously Freddie and Fannie agency, you have HUD, and you have bank, credit union, debt, and then you have all sorts of various forms of bridge debt. And then you have pref equity, which is preferred equity, which goes in the capital stack.
Okay.
And then if you're doing development deals, you can do senior debt with what's called CPACE if it's eligible. And CPACE is, it's approved in about 20 markets right now, and that goes in the capital stack. So a lot of developers use CPACE because it's like pref equity. It requires the developer to come in with less money. So that's why they put CPACE. It incentivizes, it's a state approved. So in like California, for example, you can do CPACE. So let's just say I'm building a $20 million apartment. I get 65 or 70% LTC, which is loan to cost from the bank. And then I get in the capital stack, I put CPACE for maybe 15 or 18% of the total project cost. And now the sponsor only has to come in with a lot smaller margin. So the CPACE, what it's really designed for is for the good of the world and the environment, because CPACE financing finances green eligible items like LED lighting and certain foundations and energy efficiencies essentially. But developers like it too, because it means less capital raise and less equity into the deal, which usually means higher ROI for the investors. So there's all these components. So pref equity comes in typically when you're getting some senior financing, but you're short and you're not going to raise it through a syndication. You sometimes will bring in a pref equity piece, which is these large conglomerate companies that come in and they'll take a share of, it could be in the form of debt or equity, or a combination of both. So there's also in certain areas, there's new market tax credits, there's historic tax credits. There's a lot of ways that on these bigger projects, you're able to get the financing structured, what we call the total capital stack, the capital stack of the deal, senior debt, junior debt, tax credits, CPAs potentially. So you can really structure this. And that's what the really experienced ground up developers start doing is they piece these financing capital injections together to create a high leverage financing package.
Awesome. Thank you. You talk about HUD. The hikes in rates right now, HUD is much better, I would say. So can you elaborate more about HUD financing?
Yeah, so HUD advantages are fixed rate, 35-year amortization. On construction projects, it's 40 years. So, and the rate's fixed for the whole time. So it's not like a 5-year fixed amortized over 35. It's like a straight 35-year fixed rate. So back in the lowest points, you could close these deals in the high twos. That was, many moons ago now, but the point is HUD is very good for a lot of developers use HUD for construction projects, because you can't beat the financing.
No.
The downside of it is you got to be experienced developer, and also they use, like when you're building these ground up projects, they use it's called Davis-Bacon Prevailing Wage Act. So in high cost markets, HUD doesn't work really well for ground up construction projects. So there's all these caveats, but for most developers in like kind of the Midwest markets, the lower cost areas, HUD seems to work very well. And where else can you get, 40-year amortization fixed at, better rates than market?
Yeah.
And you can only take two distributions, two annual distributions a year. So if you're syndicating a deal, you can't pay your investors quarterly. There's annual reporting that's required with HUD. So it's a lot more labor intensive, but it does fill the void in certain instances. You can do very high leverage financing. There is also even higher leverage financing if you're doing affordable housing. You can work in tax credits. So that's why a lot of the larger kind of affordable housing projects or, certain markets make more sense for HUD. So it really depends on the deal, but I would say it's not the best product that's going to work for somebody that doesn't have experience. You have to be an experienced developer, I think, for it to really work for you well.